JT is an M&A advisor out of Atlanta, and have had the opportunity and pleasure to get to know him over the course of the last, 12 or 15 months now, and does a great work with his clients. Very educational, and excited to have him as a partner and as a colleague to be able to sit up here and just talk about what's it like from a acquisition perspective when somebody goes out and buys a business. So before I get too much further, I should stop and recognize our fantastic audience that has joined us on the streaming version here on YouTube as well as LinkedIn. I'd be remiss if I didn't say I appreciate y'all dialing in and listen to me ramble into a microphone. So with that being said, so JT, obviously one of the things that you and I have talked about a fair amount over the course of the last couple weeks and months is when somebody goes to sell a business, and most of the time when we think about it from our client's perspective, they built one business. They're in their 50s, they're in their 60s, and they built one business and they're going to sell one business. Whereas most of the time, the people that they're selling it to have bought multiples of businesses this year and for years prior to that. So we're dealing with professional buyers and a one-time seller. So with that in mind, one of the things that we talked about earlier as we kind of think about our questions is how do professional buyers approach a deal differently from that one-time owner, that one-time seller?
Yeah. So thank you, by the way, for having me here. Appreciate the hospitality from Triple C and the friends here at Portus. So you said it exactly right. The professional buyers buying 30, 40, 50 businesses over the life of a fund or an investment period. And a lot of the business owners that we work with, almost all of them are founder, family owner businesses that it's their life's work, it's their legacy as a family. And they might be approached by a buyer, strategic, financial, what have you, to sell their business. And immediately out of the gate, they're at a disadvantage. There's a power imbalance that exists between the buyer and the seller. The buyer is frankly prepared. They do this professionally. They're acquiring the business for strategic reasons, whether it's, again, a financial buyer or a strategic buyer. They're buying it for a strategic rationale in some way, shape, or form around the industry, around the market, what have you. And they've identified or have been introduced to your business or a business that fits that profile. And they're coming prepared, meaning they have formal M&A counsel. They have accounting, both internal as well as external. They have some sort of an advisor, whether it be, they have a full board and all that, right? But they have some sort of an advisor, whether they be in-house or external, a buy-side advisor like myself. We're sell-side guys. But they have a team of professionals to assist them. The biggest deal done last year was the merger of Norfolk Southern and help me with this. It was the two train businesses, $88 billion, and there were advisors on both sides. Okay, so the biggest companies in the world are using advisors, and I'm not talking about just M&A advisors like myself. I'm talking about the rest of the members around the deal table, because again, it's a complicated process. It's not like selling your home. It's not a 4-bed, 4-bath in a certain zip code. It's a living, breathing organism. It has a sales team. It has suppliers. It has customers. It has operations, equipment, needs, et cetera. And there just exists this imbalance of power between a buyer who does this regularly and a seller who is doing this once. So I hope that answers the question.
It gets us certainly down the right path, right? So when we think about sellers, oftentimes sellers, the first thing, and maybe in some regards the only things that they really think about is, I have a target price, right? Like, I want X. And they know now most of the time that X is derived from, I have $1 million in revenue and my EBITDA multiple should be 5. And so you should give me $5 million. So that's like the buyer wall. So it's like, I need $5 million, or I need 10 or 50 or whatever it ends up being. But that's not how, so that's the only thing that they have in mind. But what are buyers actually buying? They're not buying an EBITDA multiple. They're buying what?
Well, I think it's worth noting, and we've run a lot of different processes. We run processes hoping to get the highest price. We run processes for gentlemen or owners that are dealing with some sort of medical issue and have to sell the business because there's not a succession plan in place. But from a process or who do I sell to perspective, really at the end of the day, it's the best buyer. And sometimes the best buyer is not the best price. The best price, that is certainly a consideration. There are things that can be done. We talked about deal team a minute ago, having a deal team on your sell side for you. There are things that can be done to mitigate your tax liability because ultimately the best price may not be the best net price. So there are some things that can be done to raise the net price and certain tax strategies and what have you. John and William can certainly discuss. But at the end of the day, selling a business is oftentimes, given that it's a founder family owner business, is oftentimes as emotional and psychological as it is financial. Leveraging the advisory network that you have can help identify those pain points as to how much truly is enough for me and my family based on our goals. But more importantly, what is the right buyer to continue the legacy of my business? What is the right buyer to take care of my people who are sometimes family, come over for Thanksgiving dinner, my customers, my suppliers I might go hunting or fishing with? I want to make sure that they're taken care of. And that, frankly, my reputation as a seller is not tainted by the sale to you, the buyer, right? And so working with folks to identify the right buyer is frankly more important, in my opinion, in my experience, than the highest price. I'm not saying the right buyer isn't the highest price. I'm saying it's flipping the priority to finding the right fit for your business and doing the legwork to understand what your sensitivities are as an owner, but also no different than the buyer is going to be diligencing your business. You should diligence that buyer. We just talked about that buyer having done 40, 50 transactions. Talk to those transactions to get to understand those people and did they do what they said they were going to do? And obviously things are going to certainly change because you no longer are the owner of your business, or certainly the majority owner of your business. But do your homework, do your work. You're only going to do this once. Most people are only going to do this once. There's not many people that sell more than one business over their career. It's worth the effort to prepare yourself and establish proper expectations and understand your sensitivities and articulate those sensitivities to the people around you.
Yeah. Last month we had kind of sticking on the price point,
Sure.
right?
Yeah.
I think a lot of people think I'm going to get an offer and then that offer is what I'm going to end up getting.
Yeah.
And as you get past the LOI, then that's where the real process starts, right? Or I shouldn't say the real start, but it's the next stage of the process starts. And John Lesnick, who was here last month, ended up backing out of his deal after the LOI as the terms of the deal continued to change. And they ended up going and selling to an ESOP instead. And so talk a little bit about how those terms change, why those terms change, and what you can do to be prepared for it and to mitigate some of that after you think, ooh, I found my person, I have my price, I can go celebrate because that's the number that I'm going to get, right?
Sure.
Like, how do you mitigate some of the post-LOI risk in the deal?
So I'll answer your first question first because the mitigation will take a little bit of explaining. But number one reason deals fail is financials. Number one reason is a set of financials were presented to a buyer. The buyer is going to do what is called a quality of earnings. You might be audited, you might be reviewed, you might have a great accounting firm that does all of your financials. Quality of earnings is very different than an audit or review. Quality of earnings is a cash proof. It's a qualitative analysis, not a quantitative analysis of your earnings of your business. That's number one reason that deals reprice and ultimately fail as a result of that reprice. Okay. Other reasons that they start failing is frankly sloppiness on contracts, sloppiness with regard to HR, sloppiness on processes and procedures. You got them to an LOI by providing a certain set of information and telling a certain story. Once under LOI, It's now a confirmatory diligence process. They're confirming what they were told. And the more things that they can't confirm becomes the death by 1,000 cuts. Okay. So how do you mitigate that? You mitigate that by building a business or preparing your business for a transaction that is worth keeping. So I'll say that again, a business worth selling is a business worth keeping. So what type of business would you want to keep? That's the business that you should look to sell. And there's things around, financial reporting. We pre-COVID, I would say a quality of earnings, 1 in 5 transactions that we sold would do a sell side quality of earnings on. A lot of sellers viewed that as sunk cost. It's relatively expensive to do, but it's 1 in 5 pre-COVID. Post-COVID is about 4.5 out of 5 have done a sell side quality of earnings. There's been a lot of volatility coming out of COVID. What is this business's true earnings power? So a lot of times that sell side quality of earnings will identify maybe some skeletons in the closet with regard to reporting, maybe some issues on revenue recognition or what have you, that can be addressed or at least brought to the forefront so the proposal that you receive is aware of those issues when they do their own buy side. Essentially, the buyer is not going to find anything that we haven't already found ourselves. So the price that the buyer puts on the table is taking into consideration that risk. Okay. Other things to help mitigate that, pretty simple. Blocking and tackling of a business that likewise you would want to keep. Are your I-9s in order? Everyone says, yes, my I-9s are in order. Do you know that for certain? I see a head shake. I don't know. Do you know that for certain, right? Like, are your contracts signed? I know that sounds silly, but there's a lot of businesses out there that send out a PO, send out a contract, and it's signed by one party, not the other, because you got an email that said we're good, right? Buyers aren't necessarily looking for reasons to chop legs after an LOI is entered into, but don't give them one, right? So it's professionalizing everything within your business. I'm not saying be a public company. I'm not saying anything like any public companies have problems with it. But I'm just simply saying that, these professional buyers that are buying your business are also professional sellers. And I'm referring to private equity, right? Private equity buys businesses, private equity sells businesses. Where private equity adds the most value in ownership of a business is professionalizing that business for the sale 5-7 years after they bought it. That's the big synergy case that they have. A strategic buyer has a synergy case because they can share costs and they can get rid of some people and they have a bigger sales organization, right? But the reason private equity buys your business for 7 times and sells that same business for 10 times is because they professionalized it in all aspects. They professionalize a sales organization, an ERP system, again, HR function. A lot of business owners that we work with, I've worked with business owners that started their business out of their carport. I've worked with business owners that started with 1 truck and a guy and knocking on doors. Okay. A lot of these guys, a lot of business owners, maybe some business owners that are listening today, started their business with one goal. Let's go get a sale. And then that goal turned into, all right, we got to fulfill that sale. How do we find a product, a raw material to convert? We got to get some equipment. We got to maybe get some people to work on this, right? And then all the business starts growing and growing and growing. But the last thing that they start focusing on is the financial reporting, the HR. Yeah, we need to hire people, but are we doing it the right way? Do we have an actual HR process, right? Again, the more professional your business is, that's like the tail wagging the dog to some degree. But when you're selling your business, that's at the forefront of the diligence. Is this business worth buying at a premium? An A asset right now, we were talking about this earlier, an A class asset, I would say a business that is professionalized is trading at an A plus price. A B asset is trading at a C price. There's a dislocation in the market, and that's all comes down to professionalism around the business. So I know I talked for a while, so hopefully that answered it.
That's interesting. So I've been told to hold the microphone lower, so I apologize. I'll keep playing around with the right distance. Anyways, I think
Am I good?
Yeah, I think of Ricky Bobby, right? What's the right distance?
What do I do with my hands?
Yeah, what do I do with my hands? But no, so you mentioned it that the business was centered around the first thing being a sale, right? Like a lot of business owners, the first job was to create an income for themselves. Yep. And then they were really stinking good at their craft. And so the business grew and it grew and it grew some more. And so they're great craftspeople and not necessarily great institutionalized business owners, right? So how long does it take to take somebody that built a phenomenal business as a craftsman and institutionalize it into a professionally ready to be sold business? And I'll add a layer of complexity because you mentioned it with pre-COVID, post-COVID. Has that changed over the course of the last 5 years with more sophistication, more money in the private equity space?
Yeah, I mean, there's a lot to unpack there because it's certainly industry specific. So thanks for asking a really easy question.
That allows me to drink more while you talk.
Yeah,
So that's the purpose.
yeah. Thanks for giving me a beer too.
Yeah.
So, look, I mean, it's obviously company specific is the answer, right?
Yeah.
I mean, of course, it depends, which is, I think, the go-to in all people in finance. You know, I'm
But you're not-
cautiously optimistic.
You're
right?
not an attorney though. So
No, I'm
yeah,
not. That's why I can say whatever I want. So, you know, look, at the end of the day, it's circumstantial to the extent that there's a broader market, right? There's geopolitical risk everywhere. There's tariffs. And I'm talking about the environment that we're in, right? You know, 5 years ago, there was a COVID environment. There was a supply chain issue environment. There's always going to be something, right? And your industry or your business is going to be impacted differently by that. I would say that, at least from our perspective of involving or starting to talk about a deal team, it's not something you wake up on a Monday morning and say, I want to sell this business. Let's go find somebody, right? This is something that you should be preparing for, ideally many years out. But, you know, we've been involved in transactions. I feel like the most impactful transactions and smoothest transactions that we've been involved in, 2-3 years prior to go to market. You have to look at your life stage, right? How old are you? Are you in your 40s, 50s, 60s, right? Depending on who you sell to, you may be asked to stick around for a couple, 2-3 years. If you're in your 60s or 70s, you're probably closer to an exit than the guy in their 40s, right? So it depends on your motivation. You know, are you looking to sell to a private equity firm and maybe roll some equity into that deal and maybe get a second bite of the apple later on? Are you looking to sell to a strategic and go fishing, right? So I think it really does take time, and it takes conviction to do it and being intentional about it. And it's not a full-time job. It's really surrounding yourself with good people. You know, I've run into a lot of businesses that are $10 million of revenue that have a CFO they're paying $300,000 a year. I run into $100 million businesses that don't have a CFO and they got a controller they're paying 60. Okay, so is there a right revenue to hire a CFO? I think that's, again, circumstantial to your business, complexity of your business, right? But, you know, as far as COVID is concerned, that obviously turned the world on its head. And like I said, pre-COVID, I think earnings were relatively, predictable. Post-COVID, particularly in the industries that we work more broadly in I would call blue collar businesses, so industrial services, et cetera. I actually grew up in a pest control company as an example. We do manufacturing, distribution, construction. And, post-COVID, huge bump, overreaction, supply chain issues. Everyone needs a bunch of inventory and they need it right now. And then post-COVID, it was this destocking. We have too much inventory. Supply chain came back. So these businesses fluctuated like this, right? Now you have a little bit of a sawtooth with 1 month is good, 1 month's not so good. When is the right time to take this business to market? Frankly, as far as you can put COVID in the rearview mirror is a good start. But it's circumstantial to your industry, to be honest. I know it's not a great answer and it's a long-winded answer, but it's also a feel and it's a life stage. And, I had a client that I sold about 2 years ago. I met him 10 years prior. I had a deal sold last year, met him 2 months prior. So it's circumstantial on your personal, as well. Because your business and your personal life, whether it's assets or time, are so commingled that a sale of the business is really hard to bifurcate that, both your personal and your time, your finances and your time. And thinking through that, planning for that, is important.
Those that know me well know I love to use the word bifurcate. So it's awesome to hear you say that as well.
You're welcome.
I appreciate it. But you said something in there that I think every time I've talked to you, you've mentioned in the past, which is you mentioned the team. right? And the team that's there to support and help the owner. Can you expand on what you talk about when you say team?
Sure. Caitlin, do you mind pulling that third slide up? Keep going. One more. Thank you. I don't know if people online can see or not. Your deal team is important. Selfish plug, we're right in the middle at the top. But your deal team, consists of those parties up there and maybe some derivation of additional advisory work. But and I'll start on the right side. The M&A attorney is important. I think everybody in here knows an attorney, fortunately or unfortunately. I don't know if there's any attorneys in the room. No offense. I'm clear. All right. But an M&A attorney is an expert in M&A. It would be like, I have an attorney, like he's a business attorney, he's a divorce attorney, and unfortunately I've worked on deals with divorce attorneys. But an M&A attorney is no different than going to an orthopedist for knee surgery and not a cardiologist. And I know that that's life and death because it's medical, but they understand the market. Going to an expert that knows market terms is extremely valuable and important. Time kills deals at the end of the day. If you have an attorney that doesn't know what he's doing or doesn't do this professionally, time's going to drag out and the deal is going to die. We actually did a deal. We were talking about this earlier. We did a deal. We closed it about 3 weeks ago. General contractor and water, wastewater, and the deal got delayed due to some I-9 issues. Deal got delayed about 6 weeks, and during that 6-week period, he had a gentleman unfortunately fall off the top of a water tower and die during the sale process, right before closing. That's a problem, obviously. It's terrible for the family. It wasn't his fault. It was a sub of a sub. But the point being, time kills deals. It had the potential to completely, the deal would have failed, and it wasn't one of even his employees. So strongly suggest M&A attorney. That's frankly, one of the most important members of the deal team. Other deal team member, as you can see on here, is your management team. You can't do this alone. This is and I don't know if I can say this, but this is a colonoscopy of your business, okay? You cannot do this alone. The request list that we get for diligence, confirmatory diligence, I'm talking after the LOI, moving towards closing, it's 300, 400, 500 requests. It's massive. And you need help. And you need to have somebody on your team that is ingrained in the business, not a third party like us, but ingrained in the business to help you gather that material. Because if you fall asleep at the wheel of running your business, it's going to affect 2 months later when you go to close the transaction. Because every month that you close, financials, they're going to be requesting financials. And if the business is on a decline because you're focused on answering a request list, it's going to suffer. Okay. So bring people under the tent that you trust that also won't be too upset about the business transacting. Okay. Up on the left side, wealth advisor, also a little shameless plug. But I do think it is very, very important. Your business, more likely than not, is an ATM to some degree to your lifestyle. Most business owners that we work with, their business is by far their largest asset. They might have a couple houses, boats, cars, whatever, planes maybe, but their business by far is their largest asset. And when you approach an M&A transaction, at the end of the day, you're decoupling or you're turning that ATM off and having a wealth advisor advise you from a tax planning perspective, charitable giving perspective, et cetera, is extremely important. We've actually, another funny story, we've actually sold a business. It was I'll just say building material and supply business. There were 4 owners. One of the owners, we were on the funds flow. It was a large transaction. It was a 9-figure transaction. And one of the owners was pocketing about $30, $40 million. And he sent me his wiring instructions to a checking account at Regions Bank. And I said, his name was Kevin. I said, Kevin, do you have anything else? Like, has this bank account ever had $40 million in it? He's like, no, but I talked to my banker. We're good. Just send it here. And I was like, maybe you should talk to a wealth advisor. JT, stay out of my business. Okay. What ended up happening was the bank froze the funds for 4 weeks due to AML and OFAC because they didn't ever have $40 million in the bank account. And they froze it and had to get copies of the purchase agreement, which he was reluctant to share, et cetera. So there are ramifications to not being organized, and a wealth manager, wealth advisor can certainly help you with that. And like I said before, gross number is important. That's the country club number. Your net number is more important. You could actually sell a business for less gross and make more net than the other guy next to you. So having that wealth advisor is important. And then CPA tax advisor, we talked about a sell side QofE. They can certainly help from a tax perspective to limit that overall tax liability. They can help prepare the financials in a way from a quality of earnings perspective that a buyer would not necessarily find anything that you haven't already found yourself. Maybe you can even make those changes. And then last, there in the middle is an investment banker. Ultimately, what we do is our role is to act as the quarterback of the transaction. There's a lot of planning that goes before. There's certainly a lot that is done after. But as far as the transaction is concerned, we talk about professionalism. I think that's the theme of the conversation here, right? But we talk about professionalizing your business. Running a professional process is equally important. Dealing with a buyer by yourself, DIY, as you say, right? Doing it yourself. You lose leverage. You lose a competitive process. The material that is shared is typically not presented in a way that maybe it would have yielded a better value for your business. So we do this professionally. Investment bankers do this professionally. Highly recommend you hire professionals around that deal table, maybe even more, and certainly involve your management team.
You talk about it. Time kills all deals, right? So death by 1,000 cuts. Basically, all of that is a result of kind of sort of red flags, right?
Yeah.
Buyer walks in the door, they see something, they all of a sudden start to sniff around. Like during your process or during the M&A process prior to actually going to market, how do you try to uncover and flush out those red flags? And then if you don't, how does that process unfold when the buyer finds the red flags?
Yeah. I think that's just a trust issue. Ultimately, when you look to hire advisors, it's hiring people that you trust. It's hiring people that you can I'm not going to say have a beer with. I mean that jokingly, of course, but because I don't have one, by the way. That's why I'm joking. But no, it's working with people that you trust, that you know have their best interest in mind. And what I mean by that is you can be open with these people about your personal financial situation. Be open with them about what you believe are maybe some shortcomings about your business. I actually use the analogy. I was talking with Chip earlier. We were just joking, talking, having a beer. But I said, and the analogy I used was, and I'm from Atlanta, so I'll just say the Atlanta Falcons, which I'm not an Atlanta Falcons fan, but when the Atlanta Falcons tried signing Matt Ryan, and at the time that was the largest contract in the history of the NFL. When they tried signing Matt Ryan told them everything about his touchdowns, his completion percentage, his wins, his 2-minute drill, everything. Falcons told him, what? Oh yeah, we agree. Like, here's $1 billion. No, they told him about his interceptions and his incompletions and his fumbles and his losses, right? And that's really the process here. The process here is coming to terms of what was the largest contract in the history of the NFL by identifying shortcomings, by the Falcons identifying shortcomings of Matt Ryan's performance. If you can identify those shortcomings, you have one of two options. You either change them, right, into a positive, or you simply just own up to them. This is a shortcoming of my business that, frankly, we perceive as an opportunity for you, the buyer. Okay, and the more opportunities you can present the buyer, opportunities are a little different than risks, right? The more opportunities you can present to the buyer, the more, frankly, the more attractive you become as a business, and possibly even above market premium purchase price for that business. So what we do is exactly that. We do what a buyer does. We look at financials, certainly not a QofE, but we look at financials. We look at how business operates. We look at the personnel. We look at, again, suppliers, customers, and just poke holes in the business and ask some tough questions that sometimes are a little bit uncomfortable. But at the end of the day, if we can be honest with each other, if we can be transparent, if we can be candid, then that builds trust. And that transparency of, you know what, I have a great business. Here's some things that I'm lacking. That transparency is super valuable. And I tell all my clients, like, don't be afraid to tell me the good, the bad, the ugly, because I need to know before they know. And if I don't know that before they know, I can't help you. I can't help spin the story. I can't help tell the story. I can't help address the issue. So I just advise, just be transparent with your advisors. You hired them for your advice, and they can't give you good advice if they don't know all the variables.
It's almost like an attorney with the witness on the stand, right? Like, you don't want to have not told your attorney the information, because then all of a sudden the other attorney finds out, and you're caught in a bad spot.
That's
right.
That's right.
So if you're at the negotiating table and they find out about it, you hadn't had a chance to digest it, unpack it, understand the positives and weaknesses of what they just found out. Right.
Look, we're not the judge, jury, or executioner. At the end of the day, we're on the same team.
Yeah.
But I just need to know what they're about to find out.
Yeah.
And we can spin it a certain way. We can couch it a certain way. We can story tell a certain way to make it into a positive as best possible.
Financials are a key component of the deal, right? We would agree that financials kind of matter from time to time.
Pretty important.
What do they look for right out of the gate, right? Like a buyer, like when you're presenting financials and then they receive them, what are some of the first things that they're looking for?
What do you mean?
The buyer, like a strategic buyer's coming in the door, you presented everything. What are the kind of things that are looking for to find red flags, to understand how the business operates? Like what about the financials, other than the EBITDA, right? Or what the margin is? What are the things that they start to unpack and dive into?
So first, I would never share financials with a buyer until working with an advisor. Okay. But what is a buyer looking for? A buyer's looking for stability, right? A buyer's looking for some semblance of growth, not only in top line, but also in margin. Understanding, if you're a manufacturer, understanding certainly things like material margin, conversion costs. If you're a service provider, understanding things like attrition, customer loss, customer gain. Okay. A lot of business owners, again, like, nobody up here is from the IRS. Nobody up here is in judgment whatsoever, but business owners, myself included. We live in a business owner world, let's say, with certain business owner type expenses that we put onto our businesses. Okay.
Be referring to personal expenses?
Not me, of course. No, not me, of course. No. But some people I know do.
Other people.
But point is, that's not the business that the buyer is buying. The business the buyer is buying is a business that William doesn't own any longer. So, being able to present a set of financials that the buyer, financials of a business that the buyer is buying, is super important. That's where the quality of earnings actually comes in as well. So what are they looking for? If you got a lot of volatility, hey, what's next year, the year after going to look like? Anybody with an Excel, any sort of Excel background can put a financial model together. What is it substantiated by? Is it substantiated by a backlog? Is it substantiated by margin improvement? Is it substantiated by new hires? Where is it coming from? So, I would highly advise against sharing any sort of financials with a prospective buyer that haven't been either reviewed. And I'm not saying reviewed from an accounting perspective. I'm saying reviewed by either a third party QofE or investment banker, because you could be shooting yourself in the foot based on what you're presenting. It may not be accurate either. Every dollar of adjustment, we just talked about, owner expenses that are going to run through a business. If you sell your business for 7 times earnings, every dollar of expense is $7 on purchase price. Now add a couple commas and zeros. It's a pretty meaningful impact.
I've been places in the past where people almost recommend from the very beginning to keep 2 sets of books, one that qualifies for tax purposes and one that qualifies for non-tax purposes. How do you, for people that run personal expenses through the business, what's the best way to handle those as you approach sale time?
Not necessary.
Yeah.
Don't do 2 sets of books.
Yeah.
Don't do 2 sets of books. If the second set of books makes it to the investor or buyer in some way, shape, or form, you open up a whole new can of worms. Just do 1 set of books. Do them legit. Do them under accrual. If you run personal expenses, run them through them. That's okay. Just make sure you're keeping track of them. And you travel. You have a couple cars. We sold a business about 2 years ago. He had $6 million in adjustments. He built his lake house. He had a plane. He had $6 million in adjustments. Buyer looked at it. Adjustments were substantiated. bought the business. Just be honest with yourself. You're not again, it's don't hide behind what you're doing. Just be transparent about what you're doing. Be transparent with your advisors, but certainly, you know, I don't think it's worth the effort to do two sets of books. It's a pain in the butt to do one set of books. So, yeah.
Yeah. What we were talking about it a little bit earlier, in terms of, again, to stay on the theme of professional versus first time. Um, what are some areas of disorganization that you typically see or you might see
Mhm.
from a seller, right? Like, that the buyer's not going to want to see? Like, where can sellers be more organized, more structured in the way they approach their business, so that when, if they're 10 years away now, so that they can start thinking about, ooh, I should be doing this better and better, so that when it is time to sell the business, I don't have to last minute rush to get everything together,
Sure.
right?
That's a good question. So contracts is number one. Make sure your contracts are good. And I'm not talking about just making sure they're signed. I know we talked about them making sure that both parties have signed it, but like it's okay to spend a little bit of money to have an attorney review a contract, especially if it's a meaningful contract. It's okay to spend a little bit of money to have an attorney review an employment agreement. Okay, it's not wasted dollars. It may feel like it at the time because, oh well, he already approved that one. I'm just kind of changing the name and the PO here. Um, just have make sure your contracts are what you intend them to be. A lot of contracts have change of control provisions. A lot of contracts have consent rights, assignment rights. Like, you don't necessarily want one of your customers to block your sale, and that customer is a meaningful customer. So, contracts would be a very important thing. People, personnel, and I'm not talking about hiring and firing. I'm talking about the actual process. I'm talking about, employee handbooks. That's easy, right? But I'm talking about, what do you do to recruit? How do you attract new talent? How do you hire them? How do you train them? When you do have to, unfortunately, get rid of somebody, what is the process that you're implementing? Is it professionalized, or is it, here's the door, see you later? Like, have you done the right things around reviews, et cetera? I mentioned the I-9 issue, right? Everyone, some states don't require you verify, some states do. Like, do it right. A lot of contractors actually that we've worked with, they have a Hispanic, typically a Hispanic, hourly employee, and for convenience have given them an I-9 that is in Spanish, just for convenience, because they can read it and what have you. A Spanish I-9 is only legal in Puerto Rico. It's not legal in the rest of the United States. So that I-9 is, in and of itself, on its face, fraudulent. So things like that a lot of people just don't know. Frankly, I didn't know that until that particular deal, if I'm being perfectly honest. But you learn something new every transaction. So, but yeah, it's just, having a third party CPA that is either doing your review or doing your audit. If you're a smaller business, it's okay, have John Smith PC, but I would recommend, as you become a larger business, working with John Smith PC doesn't carry nearly as much weight as working with maybe a larger regional firm or even a national. I'm not suggesting you need E&Y or Deloitte, but the point is, like, there's a good, better, best level. Okay. If you're working with a good advisor, but you want the best for your business, you should look to upgrade to that best CPA advisor. So, all goes back to the professionalization, right? So that's what a buyer looks at. And if they see one thing, then they see another, and then all the stuff they've already looked at, they're going to circle right back to and look at it with a fine tooth comb, a lot finer than they looked at it the first time. And that's when the deal drags. And that's when the death by 1,000 cuts comes.
So as we start to move towards wrap up stage, and I guess maybe questions from the audience, one kind of selling question. So when, as a seller, as a business owner, as I'm ready to sell my business, right? I know that it's 2 years away from selling the business, and I start talking to M&A people. There are certain M&A people that specialize in selling red pools, and there are other ones that specialize in selling blue pools, and then there are others that just sell businesses. The general thought, and everybody has a reason one way or another. Your experience on what they should look for and how they should evaluate that, as they move through the process of hiring an M&A advisor?
Sure.
And it's okay to just say that everybody should just hire you. That's a perfectly suitable answer as well.
Thank you for
Thank you
for that.
Yeah, you're welcome.
So it's not like hiring a realtor for your house because it was your wife's friend from tennis. Okay. So no different than you would, frankly, do diligence on the buyer. You should do diligence on your advisor. And again, we're not the right people for a tech business. We're not the right people for healthcare. We do really well in our industrial, frankly, because I don't understand it. I don't know. I don't even know how to spell AI. Okay. So, but I would just suggest that, you do work on them, not necessarily the industries that they've done. I mean, that is important, right? Certainly if it's tangential or it has a widget and you make a widget, right? Like, or if it's distribution and you're a distributor, I understand that. But nobody can be the expert. There's maybe one guy in the world that's an expert in blue pools, using your example. Okay. There's a lot of investment bankers out there, and it's really finding the guy that you jive with. It's asking him to give you references. Now, what's interesting about references, I think they're kind of funny because everybody gives references, myself included, references of people that are going to give you good referrals, good testimonials, right? Talk to people that have worked with them. Talk to an M&A attorney. Hey, if someone asked me, JT, what M&A attorneys have you worked with? Can I speak with them about how you work? That M&A attorney has no reason to say anything good, or like, who have you worked with? Oh, well, here's Mathesh, and speak to him, and I hope he says good things, but because we were part of the same deal team together. So I would just say the same thing. It's just taking the time to do diligence, not because somebody works at Keller Williams and plays tennis with your wife. Okay. Take the time to do diligence on them.
So parting thoughts before I close up, for buyers that are 2 to 5 years away from selling the business, any hot tip for the day?
Any hot tip?
Yeah, like buying NVIDIA or anything
Any
like
hot?
that?
No, do not buy NVIDIA.
Bitcoin.
Do not buy NVIDIA. Reinvest in your business. Yeah. Reinvest in your business, and that's the hard part that we see in a lot of the business owners that we work with, is that their ROI on reinvesting in their business is higher. Most business owners is higher than they believe it will be in the public markets. So that is a difficult conversation, but it's also a different risk. It's a different risk appetite. So I would say continue driving your business. Try to make yourself as obsolete to your business as possible. If you are in control of the largest customer and you have the supplier relationship, and you make yourself less attractive to a third party, because that business is reliant heavily on you, in which case your transaction, either price-wise or structure, i.e. earn out or what have you, could change materially. So make yourself as obsolete as possible. If you left for a month and went to Greece, is the business going to survive and continue to grow? That's what you should be asking yourself. And how can you do that? How can you continue to implement automation? How can you continue to implement AI? If you're not implementing AI right now, you're already behind. And I'm talking even just scratching the surface of it. AI is a game changer across all industries, ours included. And again, it's just scratching the surface. And I'm firmly of the opinion that AI will, and it already has started to evolve into industry specific. Actually, I was at a plastics conference not too long ago, and they were talking about using AI to minimize scrap on plastic injection molding. An AI scanner, and here's how you do it. And it just, I mean, again, it blows my mind that it can do that. But implementing that saves cost. Implementing that makes you a better business, a more attractive business. So I would just say, continue to invest in your business, continue to invest in your people. And if you're 2 years out, I'll be over at the bar, have a beer.
No, it's funny. You're exactly right. We always tell clients that they're going to sell the best business they ever own. That's right. And then they're going to take the proceeds and they're going to dump it into a bunch of publicly traded crappy stocks. And you better get ready and comfortable with that and the volatility that comes along with it, right? So, reinvest in the business and slowly start to understand what a different portfolio starts to look and feel like.
That's right.
So,
that's right.
Thanks for coming up all the way from Atlanta. I think JT might have made it a record time today, by the way. So hopefully there are cops paying attention to our
I got
conversation. Ways. Yeah, he drives a white Cadillac, right?
Yeah, sure.
but no. So no, but thanks again for coming. Next month we actually we've got a great guest, Martin Evile. Martin sold his business in 2020, right before COVID, I think. I drank entirely too many bottles of champagne with Martin at the end of January, and actually rolled in a portion of his proceeds into the company, and that ended up closing out about 6 months ago. So Martin's going to come up and we're just going to talk about what selling to a strategic buyer was like, and how the roll up ended up being beneficial for him, and what he learned throughout the process. He ended up talking to a couple different M&A folks, settled on the right one. And even with that, still had some hiccups along the way, right? So it's going to be a fun conversation to talk to somebody that's been all the way through the second bite of the apple, as so many people like to call it. He's English, so he talks funny, and he likes beer. So it'll be a really good conversation. Hopefully the folks online can join us in person, or if you're remote, join us that way as well. So, but thanks again for making it all the way up, and thanks for your partnership.
Yeah, likewise. Thank you for inviting me. Appreciate everybody.
About making yourself obsolete. Going through this process, if one of your top management people is planning to stay with the acquirer, but you plan as the seller to leave,
Sure.
Is it better for that person to take the lead in the conversations, or is it better for the seller to still do that even though they're?
So that's a great question.
Hold on a second, real quick, JT. Just to repeat, just talking about for our virtual folks, the making the seller obsolete, and who should take lead in different circumstances if the seller really turns out and runs on day one. Who should take the lead in different contract negotiations?
So good question. So I would hope that the seller that has made himself obsolete has also groomed that person to step into the role of running the day-to-day of the business. Depends also, I guess, on who you would sell to, right? So a strategic buyer, not necessarily is interested in hiring another president, right? So they're looking at the business from a different lens. Financial buyer who's looking at acquiring the business as a platform, that's their CEO. That's the guy that they're investing in, right? So yes, involving him in that process, extremely important. I'm not saying who leads it and who doesn't, right? Usually the owner has been part of it for 20, 30 years and has seen the evolution of that business over that period of time. But certainly involving him or that second in command that is the rising star, the one being groomed, extremely valuable. But I would just caution you to be careful. You would really want to have to trust that person. We'd really want to make sure you incentivize that person to say all the right things and to be a good advocate of not only your business, but the transaction in and of itself, and make sure you're aligned with that person. And I'm talking about financial alignment. A lot of our clients, actually, I would say all of our clients, compensate those key people on closing through some sort of a bonus, a transaction bonus, through some sort of a thank you, payment plan type bonus out of their own proceeds, right? So I would say just be careful with that, but yes, absolutely, because that's ultimately the guy that's going to run your legacy when it is sold. So involve him on that management team right there. Yeah, support and diligence.
You said legacy, which I hate to disrupt and ask another question after I just closed. Do you coach owners about how to let go of their business once it's no longer theirs, right? Like it's no longer theirs, right? They spent 20, 30 years building it up, and somebody else comes and takes control of it and they go hard left. Like, do you have conversations, or how do you how do you prepare people for the fact that you can't take it personally?
It's 10 o'clock at night after they've had a couple bourbons, many conversations. My wife's accustomed to it now. So, but it's a psychological, emotional journey I had a client sold his business. It was about a $70, $80 million transaction. And it was around this time of year, Thanksgiving, whatever, right? And he sold his business, super excited, called all his customers, they're all his buddies, his suppliers. And then he goes into the office to do his annual Christmas cards on the postage meter. And he goes in, didn't think of anything of it, did his personal and company Christmas cards. And the guys are like, wait a second, that's not your postage meter anymore. What the hell are you doing? And he was so fed up. He's like, I'm out of here. And he left for like 3 weeks. And it took him a minute just to psychologically get over the fact that nothing in that building was his anymore, including the postage meter, including to do Christmas cards for the same customers and suppliers of a business they doesn't even own anymore. So there is a psychological aspect to it for sure. And it's preparing them for what life looks like after the fact. And that's where, again, this transaction team and alignment through this deal team is extremely important, because there's a lot of behavioral psychology within an owner. You know, you are William, the wealth advisor of Portus. Tomorrow you're just William. Still a good guy. But the point is like sometimes, owners identify themselves as I'm JT, the car guy. I'm you know what I'm saying, right? And so like first question most people ask is, what do you do for a living? When they shake your hand, right? So you're no longer that person. So you have to come to grips with that. There's only so many golf courses to play. There's only so much fish to catch. Again, depending on where your lifestyle is, like having those conversations with your advisors and trying to truly understand what you want from the transaction, both financially as well as post-transaction, extremely important.
There are a lot of fish. Yes, Caitlin. Okay.
Repeat it for the audience, or
Yeah, sure. You can repeat it.
I'm just kidding. Yeah, I think it was what
mindset shifts do they need to prepare for? Yeah.
Mindset shifts, and what was successful, maybe not successful.
Yeah, do you have what made somebody?
I've got all kinds of bad stories, but yeah,
I like bad stories are better than good stories.
Yeah. So I had a client that he sold his business. He still owned a minority piece of the business, a meaningful minority piece of the business. Not shortly after they sold the business, they consolidated some locations and what have you. And he had an office. He had a beautiful office, but he had no furniture in it. So he went to Costco, bought a bunch of furniture. He had the cash, and he was just going to invoice back the company. He bought a bunch of furniture, brought his furniture in, whatever. And then, his partner, remain nameless, came in and is like, I didn't get an invoice. I didn't prove this. He's like, yeah, but I needed somewhere to sit. Like, what are we doing? And it became a pretty knockdown, drag out, lack of preparation. And he literally walked out. He was done. He's like, he gave us 2 weeks and he was out. So he wasn't prepared to have a conversation with a partner. He wasn't prepared to work for somebody. Right. And so, that would be a bad one. Obviously there are good stories out there. A lot of it comes around the strategic aspect of buying a business and you're no longer in control, and a financial aspect of it, a financial buyer buying the business. And while you still have some meaningful ownership, that financial buyer is relying on you to continue to operate the business, but now they've brought resources. So I think it's it's a mindset shift for sure. Because you are no longer in control. And that's a hard thing for people who own businesses, who have egos. And it's okay to have an ego. But that business may even actually have your last name on the wall. That's a tough thing to come to grips with. And it takes time. It takes time. I had one client actually who said, I don't care, because every time I get pissed off, I just open up my bank account. So that's what he said. Yeah. He did. Yeah.
The ultimate mic drop.
Yeah.
What you got?
Curious to feedback that question. Will buyers generally want to interview employees, especially like service-based businesses, to see one, if the employees are going to stay post-acquisition, and see the quality of the business?
Yes.
What does that usually look like?
So I would highly, highly recommend you not do that until towards the end of the process. And I'm not even talking pre-LOI. I'm talking the LOI gets you to a price and then it's confirmatory. I'm talking deal documents are pretty close to being done. Most buyers will want to meet with not necessarily the rank and file. They'll want to meet with, the key executive, the key management, right? Whether it's project managers, whether it's a CFO, a COO, what have you. Certainly the commercial organization, so your sales, your VP of sales or head of sales or what have you, you don't necessarily want to spring that on, the employee and just say, hey, you're going to meet with a buyer of our business. And I didn't know my business was for sale, right? So you want to have that, you want to set that groundwork. And that's where I go back to compensating, I think, thank you bonuses, right? Compensating them for participating in the process. But more than that, thank you for helping me get this business where it is to be sellable, right? So that goes back to involving management. But yeah, there's absolutely a time, but there is a place as well where you should be okay, or should be comfortable, let's say, with allowing them to speak with your key people. That's right. You would want to, but again, going back to the professionalism in legal, you would want to make sure that that employee is locked up with, again, if you choose to compensate them, which you should, if you're going to have them involved before you close, you should. You have a contract that says I'm going to pay you X on close, and if by signing this you are confidentiality, you can't disclose with anybody, or you lose that opportunity to earn that, et cetera. So lock them up, talk to an attorney.
With 1 minute to go of question and answer, anything else? Jeff?
What's your recommendation on what a seller should, or excuse me, a seller should say to an inbound inquiry? Because they're getting them all the time, right? And should they interact with them at all? How do they just respond?
That's a great question. That's a really good question.
So question for our online people is what should, I own a business. What should I say to people that are calling me all the time to buy the business?
Are you in the market to sell your business? I guess would be my ask back to you. Because, if you are in the market to sell your business, you're not necessarily in a place to want to disclose that to them. What a seller, look, there's investment bankers, guys like me out there constantly calling your business. There's private equity that have now hired a whole business development group that are constantly calling your business, right? So, and there's strategics that are out there with a corporate dev guy constantly calling your business. It's, I get it. It's really hard. What do you say to it? If you're in a process or you're preparing for a process, a year, 2 years, 3 years, I actually tell our clients or our prospects to just hand them off to me. Hey, I'm not, hey, I'm JT Schroeder. You inquired with Jeff, his name, sorry. You inquired with Jeff. We're not doing anything whatsoever right now, but we'll keep your name on file. Thank you very much for your interest. Have a great day. It just depends on, because you don't want to lose that contact if somebody is calling you for a particular reason. Now, a lot of these are either robocalls or just some junior guy that's, trying to prove to his boss he made 100 calls this day. But I would keep track of who's calling you. That's for sure. Because if you ever do go to market, you can reference that. Here's a list of folks that have shown at least some interest in our business, but don't feel obligated to respond, except to us. That's good.
Quick question. Do you recommend valuations for a company that's 5 years out? Gosh knows, I'm 20 years out. Valuations? Yes, no?
There are some tax implications to getting a valuation, depending on what that valuation might be. If it's a formal valuation, there are some tax implications on reestablishing basis. This is my personal opinion.
Yeah.
My personal opinion of valuations, hopefully there's not a valuations person on this call, on this phone.
Not right now.
Unless somebody is willing to pay you that amount of money, then the valuation that they did is worth the paper it's written on. If somebody said your business is worth $50 million, unless he's willing to stroke that check, it ain't worth $50 million. And running a formal process will prove that. There's never been a valuation that was done that I've ever seen that was correct. And there's been a lot of companies that have done them. Frankly, I think the more relevant exercise is working with an investment banker like ourselves to get a range of value and comps in your space. And I say range because a Class A asset trades at Class A plus pricing. That might be the range might be 7 to 9 times, and that might be a 9 times. You might be a 7, you might be a 6, you might be an 8, right? But getting that investment banker to show you the comps, why those comps were where they were, and where you fall within that range, in my opinion, is more valuable. And frankly, it's free. So it should be free. at least from an investment banker. A valuation guy will not be. But there are benefits to valuation. So for those that there are benefits to valuation
Yeah, of
for
course.
stock option plans and those sorts of things.
Yeah. So Tim.
How long does the average transaction take?
Do you mean, he asked how long the average transaction takes. Do you mean from the time that you engage with an investment banker or from the time an LOI to close? But okay.
Yes.
Yes, yes. So a typical transaction from time of engaging an investment banker to go to market is typically about 60 days. Could be less, could be more. And what I mean by 60 days, it's really availability of information, right? Investment bankers putting together a book, financial model, et cetera, telling the story, spending time with you, visiting your sites, et cetera, right? So typically call it 60 days to be conservative. Marketing process is about 60 days as well. So that's processing NDAs. That's, they would have prepared the marketing material up to that point. Processing NDAs, Q&A, site, answering questions, et cetera, to get to an indication of interest and then ultimately a letter of intent. Okay. Indication of interest is, a range of value that we believe that a buyer believes that the business is worth. I highly recommend doing that as opposed to going straight to an LOI, because you may receive 15 or 20 different LOIs and not really know how to make heads or tails. You can't simply engage with all 15 of those. You have a business to run, you have a day job, right? I recommend funnel of, I'll just use easy math, right? Out of 100 parties that you reach out to, about 30 or 40 of them will typically enter into an NDA. Of those 30 or so, about half of them will show some sort of interest, right? Maybe 10 to 15 of them will show an indication of interest. It's really only worth your time to entertain 3, 4, 5 of them. If you entertained all 10, 15 of them, that means site visits, that means they're coming to see you, and you just don't have that bandwidth in your day. So that's relying again on the diligence that you'd be doing of the buyer. From LOI to close, and this timeline has stretched and tightened depending on a lot of variables. Again, availability of information, negotiating a purchase agreement with a divorce attorney as opposed to an M&A attorney. It's call it 60 days. Typically 60 days to 90 days. So start to finish, call it 6 months. Yeah. Never let them price your goods, in my opinion. Nope. Let the buyer tell you what he believes your business is worth. You lose negotiating leverage. Providing guidance is one thing. Providing them you got to be here in order to dance is something else. Okay. So what we do, we don't provide any sort of guidance. We let the market speak for itself. Okay. We let the market speak. This isn't a truck. This isn't a house, right? Like this is a living, breathing organism. So market says it's worth $20 to $25 million. And we have 10 proposals that prove that. Okay. Now a good investment banker would leverage those against each other, they've already created the competitive environment. Now let's leverage those against each other and get to 25 or 30. How bad do you want this deal? How bad do you want to win this deal? In order to win this deal, you got to get to 35, right? Whatever the case may be, right? And that's where the expertise and negotiation and all aspects around structure and price and all those things become valuable. Yes, 95% would be exclusive. Very, very rarely will a buyer issue an LOI, have you sign it, and then allow you to go continue to talk to other folks because they're going to invest resources, time, et cetera. So the LOI is the end of the bidding process. Once you sign that LOI and gone exclusive with somebody, you have to cease conversations with everybody else. But that's also going back to your question before on timeline to close the deal from LOI to closing, keep that exclusivity as short as possible. That's right. And if you have an LOI that requires exclusivity for 90, 120 days, that's probably a red flag that the buyer doesn't have the money, that the buyer doesn't have approval for financing, that the buyer may not even have board approval. So those are some red flags. I've seen LOIs with 120-day exclusivity. It's like, we have a quality of earnings. It's a great data room. What are you waiting on? 4 months to close this thing? It's ridiculous. It may end up being 4 months, but we're not giving you exclusivity for 4 months. Good.
Thanks.
Any other questions? John had one.
Very good last question. I'm a seller. I'm looking to engage with someone like your advisor. What does the engagement look like? Are you a retainer and then a piece of the transaction?
Yep.
How does that work?
So I'll start structurally and then we'll talk fee. But structurally, back to your question on exclusivity with a buyer, all of our engagements, I speak to our firm, okay? And I know every firm does things a little differently, but I would say broadly on the investment banking world, it's an exclusive engagement. We don't want to be competing with our own client, much less some third party we don't know, and maybe we're talking to the same buyers, and that just reflects very negatively in the market. So it's an exclusive arrangement. It's typically, from our structure, it's typically a year. And it doesn't take a year, right? But it's typically a year, and it terminates at the closing of the transaction, or you can back out of the deal or what have you, standard contract stuff. And then as far as fees are concerned, we charge a retainer. It could be a monthly retainer, it could be a lump sum retainer up front. We net our retainers from our fees, from our success fee, and our success fee is when you're successful, we're successful. So what we typically do is understand what the goal is of the seller. The seller wants to sell the business for $30 million. That's my number. What we do is we do a threshold step up. So we don't do a reverse Lehman. In my opinion, alignment between your advisor and the company is really important. And so a Lehman formula is, does anyone know what a Lehman formula is? Okay, Lehman formula is like 7% on the first 5 million, 6% on the next 5 million, and it's a step down as you get higher, right? It's formulaic, it's complicated, but the higher the purchase price is, actually the less incentive that the advisor has to get you that high purchase price. So what we do is we do a smaller fee on that threshold amount, and then we do a higher fee on anything over that, just the overage. So it's incentive to, hey, I got you your number, but then I got you your number and then some. A lot of our clients, actually all of our clients, appreciate that more. Like it's called a bonus to us for running a better competitive process. Be careful. I'll say this back to your thing. I say be careful, but we do it too. So you really have to trust the advisor. Be careful about tail periods with M&A advisors. There's a lot of M&A advisors will become exclusive, and then they don't do a bunch of work. They don't do anything. They didn't find you a buyer. They didn't find you the right buyer, what have you, right? You terminate the agreement. You have a 3-year tail period that says, if you do a deal in the next 3 years, I get paid. Be careful with those types of contracts. That goes back to hiring an attorney and having reviewing that. What we do is we don't have the world as our exclusivity. We are exclusive to the world, but when the deal is terminated, we're only exclusive to the parties that we've actually processed NDAs with. So just word of advice. That's how I would approach that. Because that actually means I talked to the person. That actually means I engaged with the prospective buyer, as opposed to just sent a cold email out to 15,000 people. So just be careful with tail period provisions.
Awesome. Thanks. I appreciate it.